Welcome back. You're with us on Editors Roundtable, and we've been discussing, of course, the consolidation in the local market, the slight revival in the mid-cap arena. But the biggest global story of this week really has been the non-stop rally in the Chinese markets, and more specifically in the Hong Kong Hang Seng, even more than the mainland Chinese market. So what's really going on? Let's, put the spotlight on this. Now, the Friday moves first up. This was Friday. A lot of Asian markets were flat to slightly, negative or very mild gains. But look at the Hang Seng, 3%. Actually, by the time it ended, the market closed out. This was an intraday market trade that I took. It was almost a 4% move on the Hang Seng. The Nikkei is slightly higher. The Kospi was flat, and the Nifty, we ended down about 0.5%. But it's not a Friday story at all. This story has been in the making since the start of 2025. Look at the huge disparity in the distinction between the Hang Seng, which is up almost 19%, and the Nifty, which is down 4% so far this year. Let's go a little deeper. Like I said, this is more a Hong Kong Hang Seng story right now than a mainland Chinese equity story. So the Hang Seng, like we said, is up about 18.5%, 19%. The mainland indices, the Shanghai Composite in 2025, about 3.3%. The CSI 300 index, about 3.8%. So what's happening with the Hong Kong index? Actually, even if you dive in a little deeper, you'll realize it's the Hang Seng Tech Index that's really caught the investors' imagination. The index is up about 34% so far in 2025. But I tell you what, this is not a story that's just started this year. It's been in the making for the past 6 months or so. Because if you look at the last 1 year gain of the Hang Seng Tech Index, it's almost 70%. What has this index done? It peaked out in Jan 2021 when all the noise around tech entrepreneurs started in China. The peak was 10,300 almost. It crashed to a low of 2,720. And now the recovery, it's a very, very impressive recovery. It's come back to a level of about 5,800, which means the index has doubled from the peak. I mean, the increase is almost 111% from the low, that is. So let's move on and talk about what are the factors that are leading to this. Couple of factors. Number one, DeepSeek. The world is absolutely enchanted with this low-cost AI model that the Chinese are able to make. Then it's not just DeepSeek. There's recovery in Chinese tech earnings as well. Look at Alibaba's numbers. The stock was up 15% in mainland in the Chinese trading on Friday, 8% on Wall Street trading. And it's not just Alibaba. Even stocks like Lenovo have outperformed expectations this quarter. Then, of course, the big event was the Chinese president's meeting with the industry leaders and entrepreneurs. And the fact that Mr. Jack Ma was present in this meeting, that has really, sent a very, very positive signal out there. What did the Chinese president say? Mr. Xi Jinping is now saying that he wants a very open and fair sort of relationship with Chinese industry. No arbitrary seizures or no sudden inspections, which is what we remember, which is what happened immediately after COVID, which is where the big tech crackdown was happening earlier. That seems to be now changing, and there seems to be an olive branch that the government is giving out. Last but not the least, obviously, valuations. Look at China valuations. MSCI China is trading at about 11, 12 times one-year forward earnings. MSCI India is still trading at almost 20 times. So there's a very clear valuation difference. The question is this the real deal? Or is this another flash in the pan trading tactical rally in China? This is the Hang Seng chart of the last 1 year. The thing is, we've heard this before. We've seen this before. In May, there was a bit of a trading fillip that came through because of stimulus measures. Again, in September, there was a big rally. We thought this is the big China stimulus, but it fizzled out. And now this is the third wave going up. Just to jog your memory, a lot of stimulus measures have been announced by China in the last 1 year, starting with monetary measures. They cut the reserve ratio requirements. They cut the reverse repurchase rate as well. Then there were measures for the property market, and there were measures for the equity market. Some of them were very interesting, easier buybacks, getting a lot of the index funds and ETFs to invest more money, telling Chinese local mutual funds and insurance companies to increase their holding of local stocks. So all this has happened, but the rallies have fizzled out, which is why I'm asking, is this the real deal? Because now you have the tech companies moving higher and all the past 1 year stimulus. So will the dragon really start firing again? Because if that happens, Indian investors will watch very, very carefully, and they will wonder whether this further complicates the issue for us with respect to FPI flows. And that's really the question I want to put to Mihir. Mihir, we were talking about market ownership, and of course, it's domestic investors here. We own the market here. But FPI selling has really broken the markets back. Now, I don't know about selling or not. The fact is, with China doing what it's doing right now, if this continues, do all hopes kind of go out of the window of us getting more foreign money?
See, till about a month and a half ago, I would have said that India versus China was not the thing, in the sense because we have seen China stimulate its economy many times in the past. But it's never worked to attract flows away from India into China, right? And even in the last quarter of the last year, 2024, we did see big stimulus measures being announced, but that again didn't move the needle that much as far as flows into China are concerned. I think the Chinese tech story has somehow grabbed the attention of FPIs in the last month and a half, and I've been talking to a few fund managers. There is intense action, more so not so much to be in the tech space, but for the first time they feel that they've been underweight on China for so long that to continue to be underweight might lead to underperformance in the short term. So if you look at the FDI flows, they are still negative.
Sure.
FDI flows into China have collapsed, almost down to zero from $50-100 billion a year. If you look at the last 3 years, it's virtually down to zero, and there is net outflows of FDI.
But
so the longer-term investors are still looking at China with suspicion, which was the original story. The risk, the geopolitical risk of China being close to business, you never know when some businessmen will go to jail, etc. Those risks remain. So FDI has collapsed, but the tactical guys, the more easy money, which is easy to move around, which is the FPI money, has probably moved a bit to China tactically.
The Bank of America Securities actually said that this could be a first pivot from just being a tactical trade to being a tactical market, a trading market, to being an investable market. Right. I don't know. And if that shift happens again...
Amir, just to take this point forward, one of the counter-argument to this whole China doing well is because of the MSCI, the way the composition is, and the fact that India is a part of the MSCI, there is no China-dedicated fund or India-dedicated fund. It's an EM fund. So if the fund flows into EM for a China reason, would India be also a beneficiary of that?
Certainly, but that needs to have substantial money moving into EM, which is still not happening because the dollar has done so well. The Nasdaq is also under. So we have to compete with a lot of things, including now China's tech.
So coming back to, like, for instance, you said financials, and that's a theme that you like.
Yes.
The problem is financial stocks move higher when that big FPI pipe opens up again.
Correct.
Do you think financials can do well even without, the FPIs returning?
They should, because ultimately in the medium term or long term, obviously valuations and growth equation, that's what drives the stocks. But we also need to realize that not only have FIs sold in India, but they are also still retaining the net short positions in the Nifty futures and some of the stock futures. So if that becomes a trigger, and for me, the biggest trigger will be stability of the dollar, and which we have now started seeing in the last couple of weeks. DXY from September to September 24 to now moved from 100 to 110. It was a massive move against all the currencies, which, basically it was US dollar and nothing else versus everything else, so to say. But now we have seen the last 3 weeks, it has come down from 110 to 106, 6.5. So my view is that even if it stabilizes at 106, 6.5, that scare or that horde of money which was going to rushing back to the US may stop, and that probably is enough. You don't even need the rupee to go back to 85.
We can have a breather at least. Like this week, we can just holding our own would be perhaps something positive that we can take.
Absolutely. So I guess take a breather. Watch the match over the weekend, enjoy the India-Pakistan match on Sunday, and come back fresh on Monday morning.
That's very, very good advice, Nimesh. I'm definitely going to take that for sure. Mir, thank you so much for dropping by and giving us perspective on the market. Well, with that, we're out of time. It's curtains on this edition of Editors Roundtable. Stay tuned to CNBC-TV18. News and updates continue.